Hi, my name is George Dagnino. The purpose of this video is to show you the simple yet very profitable relationship between indicators in the business cycles. By the way, this is not my work. I studied this subject from the books published by the National Bureau of Economic Research decades ago. And in fact, I had to have them reprinted from microfiche. And and the National Bureau of Economic Research, they made a lot of studies, especially after the Great Depression, and their objective was to find out indicators that would help government to understand how the economy is growing, if there are excesses, and how the economy could be managed. And it's very fascinating how, for instance, one thing I remember is that the money supply was really the number of checks cleared by the New York banks. So really that we're trying to find the minutia of what's going on in the micro world to help to understand the macro world. And so after many years of studies and books written on the subject, there is this system of leading, coincident, lagging indicators. What I would like to do with this presentation is dig into it, show you some relationship, and after many years of experience in this area, show you what are the simplest yet so powerful relationship, which is not what you read on the financial newspapers, by the way. I don't think they're accurate. So to help you understand where the financial markets are going, what are the main turning points? What does it dictate the main turning points of the business cycles? That's where you make money or you lose money. So let's start with the high-level view of what is the business cycle. In its simplest way to understand it is, you go from phase one. This is when the economy comes out of a recession or very slow growth period. People start making money. Production has to increase because as people make more money, they spend more. So business buys raw materials, of course, starts borrowing, hires more people. So there is a positive loop that makes the economy expand. Eventually, though, growth overshoots what is the average growth of the economy. And at some point, capacity is reached, top capacity is reached, full capacity is reached, and you're beginning to see pressure on commodities, interest rates, and inflation. And slowly and steadily, yes, they start rising as unemployment rate declines and more people work, and of course they spend, and there is pressure on prices. There is a point here, though, that the pressure on prices and the rise of inflation starts having a negative impact on income. So income after inflation starts slowing down. So real demand starts slowing down. Business still believes in that the economy is strong, so keeps on building inventories. But the economy, sales slow down, income slows down. At some point, business realize they have too much inventories. They have to cut production. They have to cut purchases of raw materials. They have to cut borrowing. So at this point, somewhere in here, you're beginning to see commodities coming down, employment slow down and then decline. You see interest rates decline. And at some point in the main correction part of the business cycle, you see interest rates, commodities, inflation coming down quite sharply. There is a point, however, between phase 4 and phase 1, when business has reduced inventories, they're lean and mean, so profit beginning to improve again, and so they start building a little more, and then of course they hire more people, and the cycle starts all over again. Now, from an investment viewpoint, this is when people say we should buy growth. Of course, you buy growth in phase 1 and 2. In phase 3 and 4, you have to be defensive. But we'll talk about this later. The economists of the National Bureau of Economic Research, as I said many decades ago, devised the business cycle, the indicators of the business cycles in three categories: the leading indicators, the coincident indicators, and the lagging indicators. The coincident indicators mean what's happening now. Commodities rising, is employment increasing or decreasing, sales, income, production. So this is what's happening now. The leading indicator, of course, as the name says, they lead turning points in the coincident indicator. The coincident indicator slows down, which means production slows down, income slows down, and eventually, as we saw before, has an impact on the inflation and interest rates that decline. The decline in inflation and interest rates increases income and real income after inflation, so people start ordering materials and orders improve, housing starts improving, and you have the leading indicators start rising. After a while, the leading indicators are followed by increased industrial production, and the increased industrial production is followed eventually by inflation and interest rates. I'll have some more to say about this, by the way, but this is to give you an idea of what the leads and lags are. From an investment viewpoint, forget about this curve. This is really, it tells you what's happening, so really doesn't mean anything. What really is important to know what will happen, right? So let's focus on the leading indicator. The most important ones from an investment viewpoint are financial indicators. They tell you what will happen. It's very important, what will happen. So a decline in the growth of the money supply in commodities and in the stock market tells you that the economy slows down, but we don't care about that. But we know that after a while, as the economy slows down, eventually growth will be so low that will have an impact on inflation, interest rates, and bond yields. So they eventually will decline. As they decline, of course, this improves investments. People, business invests more, places more orders, and you see a bottom in the leading indicators, which start going up. These are financial indicators, obviously. So after the leading indicators start going up, you see that the economy grows, but there is a point, and this is the tricky part. The longer it takes, the longer is going to be the business cycle. So as the economy strengthens, at some point, we don't know when, but usually after a year and a half of strengthening economy, inflation and interest rates start rising. They start rising, and look, as inflation and interest rates are rising, what happens? Credit risk improves, increases. Housing, of course, is weak, and orders are being cut. And what you see is a peak in the leading indicators. Stock market, the yield curve starts flattening and inverting, and the money supply starts slowing down. So, but the important thing is that a decline in the leading indicators, protracted decline, will cause the economy to slow down. We don't care about that, but what we care is that it will take a really prolonged decline in the leading indicator to force the economy to drive lower inflation and interest rates. But when inflation and interest rates decline, then they will cause the stock market, the yield curve to stock market to rise, the yield curve to start steepening, and M2 to rise. This increase in liquidity eventually causes after a few months, causes the economy to strengthen, and after a year and a half, sometimes 2 years, inflation and interest rates start rising because the economy starts growing above its average growth, and there are the excesses. This is the important thing of this indicator. The lagging indicator represent the excesses in the economy. The longer it takes to develop these excesses, the longer is going to be the business cycle, meaning the longer is going to be the bull market in stocks. That's what it boils down to. And the longer is going to be growth stocks to rise. But as soon as the inflation starts rising and interest rates rise, then this forces the stock market to decline, the money supply and liquidity to slow down. And this is when it starts the correcting phase of the business cycle. What I'm planning to do now is to look at all the indicators, the most important indicators of the business cycles, the one that I mentioned in the previous slide, but dig into it in details and looking at lead lags. In other words, if the money supply slows down, when will the economy slow down? If the interest rates decline, when will the stock market rise? So I'm going to ask you all sorts of these questions at the end of the presentation. This list is just to give you an idea of the kind of objective that I have. And it's fascinating. I've been teaching this stuff for 15 years, and I also wrote a book about it. Actually, McGraw-Hill asked me to write a book about it. So you will see how important it is to recognize the leads and the lags with all this stuff. It's not what you read in the newspaper. So be patient. We'll get there. Now, these are very important leading indicators. They drive the whole thing. There are several others, but I find that these are probably the most reliable. Okay, the first one is the blue one is the M2, is the money supply M2. And the green one is the yield curve. The yield curve is the difference between the yields on the 10 and 2. The yield curve is steepening when the difference increases. The yield curve is said to be flattening or inverting when the difference decreases and eventually becomes negative, as here. Now the gray is the recession we had in 2020 because of the plague. So what you will notice that's why they're called leading indicators. Now you gotta remember this. They're leading indicators because notice that they started improving before the recession. So when the economy started growing at the end of the recession, they were already rising. That's the important thing. I know this is why now you got to think different. What they are saying, this rising, that whatever happens eventually will be okay because they are rising. Okay? What the decline is, and again, remember this date, middle of 2021. This is when the stock market peaked. This is where all the financial measures peaked. When the money supply starts slowing down and the yield curve starts flattening and then inverting, then that will tell you that a year and a half from now, the economy will start slowing down. So this will tell you that what will happen. So the fact that this is slowing down or the yield curve is steep, and it doesn't tell you the economy, my God, now the economy is bad. No, the economy is good and will still be okay a year and a half from this point here. So the future is here. This will tell you what will happen after that. So you see how you have to think in lead lags in a very different way. This thing going down doesn't mean anything about what is happening now. It tells you what will happen in a year and a half. Okay, enough. Hopefully I made my point. Okay, let's see next. Okay, we are still talking about leading indicators here. So the green one is still the yield curve. This is the yield curve steepening. The difference between the 10 and 2 is increasing. This is the yield curve flattening, and here the 10 minus 2 becomes negative, the yields between the two, and in the yield curve now here is inverted. The blue line is the growth in stock prices over 12 months. And notice how sensitive the change in stock prices is to increases or decreases in liquidity. We'll see what the other relationships later on. But for the time being, I want to make the point that the stock market, the growth of the stock market reflect liquidity in the system, which means either the yield curve rising or declining. And of course, I didn't show the money supply, but it's the same thing. And notice that they rise. Of course, here there was the plague reaction, but follows very closely the yield curve. So the fact that the yield curve is still inverting is not good news in terms of growth rate in the stock prices. When do you see stock prices rise? No, the growth of stock prices increasing, and when you see the yield curve finally steepening, then you know that the next bull market is underway. But we'll talk about this later on. This is an example of a leading indicator, which we said is the yield curve. And the red line is the employment full-time. Notice the full-time employment is a coincident indicator. Notice how they declined during the recession. But what is important is that notice that the leading indicator leads an increase in an improvement in employment by roughly a year and a half. Not only that, but also between the leading and the coincident, there is also a good 1 to 2 years lead time. So what is important to notice is, where does employment go? Obviously, it has to go down. When, and that's the crucial thing, when will employment improve? Notice that, as I said before, the yield curve increases, and then after a year or so, you have improvement in employment. So even if the yield curve improves now, this is the improvement in employment is going to be at least a year from now. So at least towards the end of 2023. That's why it's so important to make a difference between leading, coincident. This leads this turning point. This leads the peak. So you have to wait for an increase in the leading in the yield curve for a year and a half before you see an improvement in employment. So we have a long way to go. This chart shows again the leading indicator yield curve steepening, flattening, inverting. The red line represents commodity prices, producer prices, this curve here. And commodities can be used as, mostly I use them as a coincident indicator. Notice that again, the leading indicator leads commodities by a good year, like employment. And the same thing at the peak. So you see now commodities are coming down because the leading indicator peaked a year and a half ago. So what you see now is not because the economy is weakening, but it's because the leading indicator, liquidity, started contracting a year ago. This is the delayed effect. So when will commodity improve? And by the way, by commodity, I wrote an article about Bitcoins that behaves exactly like commodities. It will take a steepening of the yield curve, or about 1 to 1.5 years, before this decline in commodities will turn around and start improving. So this is what you see here is the effect of what happened a year and a half ago. And before these things will continue to decline, and they will bottom only after the yield curve has been steepening for a year and a half. Let's talk now about inflation, both from a long-term and short-term viewpoint. Now, this is what I'm going to talk about is it's not, obviously not my idea. There are much smarter people than I am. But in the 60s, Milton Friedman wrote, by the way, I have the book. Just a second, let me get it. This is the book that he wrote in the 60s, is The Monetary History of the United States. He got the Nobel Prize because of this. And what he found out with working with Anna Schwartz, that his research showed that the money supply, it has to grow within 3 to 6%. If there is 3 to 6%, inflation is likely to be close to anywhere between 1 and 2%. If, on the other hand, the money supply, the growth in liquidity grows above the 6%, like it happened in the 70s, it happened now, inflation is going to go up, and it's no matter what. So he said, inflation is everywhere, anywhere and everywhere, anytime, a monetary phenomenon. What we are having here in the last 2 or 3 years is the money supply, because of fiscal stimulus and Federal Reserve generosity. They started printing money like crazy, and the money supply started growing at 24% year over year. So it's not, this is, of course, is a leading indicator, liquidity, right? So you're not surprised that after a couple of years you see inflation soaring. So what needs to be done? It needs to be brought, liquidity has to be brought within the 3-6% as it happened in the 90s. That's why we did not have much inflation. Now, this is a spectacular thing that has happened. The money supply now is going at roughly 2-3%, which is within the range of 0% inflation. The only issue that I'm raising is that they did this sharply and causing a lot of pain for 2 years. Now they're going this way down, and they're going to cause a lot of pain already in 2022 and 23 and possibly 2024. Why? Because this is a leading indicator. And between here, as we saw in a previous slide, between here and the peak in inflation is going to be roughly 1 to 2, maybe even 3 years. So this is the issue. We're going to have very low inflation, possibly deflation. What is bad? That they did this and then this. This is not monetary policy. This is just gambling. I don't know. I'm really, really, really surprised about our leaders. This is a very important relation, and it's probably the most important one, which is so different from what the newspapers and everybody's talking about. It is the relationship between a lagging indicator and a leading indicator. This shows the yields on the 2-year bonds. And this shows the stock market in the red line, which is a leading indicator. The gray areas are recessions. Now here you have to stretch your mind a little bit, because again, is the relationship between the leading and lagging indicators. Believe me, this is the most profitable piece of information you'll probably get from this video. But it's part of a model. Okay, so what I showed you at the beginning is that the rise in a lagging indicator leads the peak in a leading indicator. For instance, rising costs, okay, produce a decline in profits. Okay, so a lagging indicator cost produce a decline in profits or a decline in new orders, for instance. Look at now the relationship between interest rates and stock prices. A rise in interest rates precedes a peak in the stock market. A decline in interest rates precedes a bottom in the stock market. A bottom in the stock market precedes a bottom in interest rates. A bottom in interest rates precedes a top in the stock market. A top in the long-term interest rates precedes a bottom in the stock market. A rise in a lagging indicator leads a peak in the leading indicators. You see the relationship? This is very important because in order for a leading indicator to rise, it takes a decline in the lagging indicators of several months. How do you apply this rule? No, it's not a rule. This is the way life works. because with a lagging indicator decline, meaning that now costs are declining, means that inflation is declining, means interest rates are declining, means that wages are declining. So the time is set, the excesses are corrected so that the economy can start going up again after all these excesses have been corrected. And this, after all the excesses are corrected, the stock market will rise and the leading indicators will rise. However, when the excesses rise, cost, inflation, interest rates, business makes less money. So after an increase in this cost, earnings decline, and of course the stock market peaks. When will the stock market bottom? Only after a protracted decline in the cost so that business makes money again. So where are we now? Well, really, the Fed is pivoting, is not pivoting. I don't know what is they going to do. What is the latest jargon? But one thing is sure. This thing, the cost, inflation, commodities, interest rates, and everything else has to decline for many, many months before this beast here called stock market start going up again. So you have plenty of time to wait and just watch the business cycle unfold. This is another important relationship between a lagging indicator and a leading indicator. Lending standards, this is, by the way, is inverted, meaning that lending standards are tightening, easing, tightening, easing, tightening. And this is interest rates, which is a lagging indicator. Why it's called lagging indicator? Because you see the economy starts improving here, and interest rates started rising after a year and a half. In this case, the economy started improving here, and interest rates started really increasing after several years. And the same thing here, the economy started improving here, and interest rates rose after a year or so. So what is the relationship? Again, the relationship is that a bottom in the lagging indicators leads a peak in the leading indicators. A peak in the lagging indicators lead a bottom in the leading indicators. Same thing here. Interest rates rise, banks are tightening. Interest rates decline. After a while, interest rates are easing. So how do you use this lead-lag relationship, which is crucial if you want to invest successfully, is that, and this is true also for business planning purposes, by the way, you have to wait for interest rates to decline substantially for several months before banks start easing lending standards. Like here, for instance, interest rates for a year and a half before banks started easing lending standards. So again, the lagging indicator is a very crucial measure to forecast the leading indicator, which is where you usually make money. This is another relationship between leading and lagging indicators. Another example, the blue line is the yield curve, the 10-2 yields, and the red line is the 2-year yield. Again, as you can see, the bottom of the 2-year yield is followed by the decline. The decline in yields is followed by the bottom, and then a rise in yields keeps this going down. Decline in yields is followed by this rise. Here, the rise yield is followed by the decline in the yield curve. What is this relationship saying right now? Well, the yields have to decline quite a bit for the yield curve to rise to then project stronger economy. So the bottom line is we need really many months of declining yields before seeing the yield curve steepening. Well, the relationship between housing starts and yields is obvious. You know, the rise in interest rates is followed by a peak in housing starts. then a decline in housing starts is followed by a peak in yields, then the decline in yields is followed by strengthening housing starts. A strengthening housing starts eventually is followed by rising interest rates. Rising interest rates is followed by a decline. The decline in housing starts is followed by a peak in yields, and then as housing starts improve and the economy strengthen, eventually after a year or so, yields rise. The rise in yields is followed by a peak in housing starts. The bottom line is, what is the current trend? Well, the yields have to decline, interest rates have to decline for several months to have a positive effect on housing starts. Here yields decline, but after roughly a year and a half, you see housing starts declining. This is why the relationship between leading and lagging indicators is absolutely crucial to understand what's going on in the economy. Well, let's try to apply everything I showed you in the previous slides, and let's make things a little practical. So let's say the stock market decline. The stock market is a leading indicator. So what do you expect? I'm not going to consider the coincident indicator, because it's not that important. So you see the stock market declining. What does that mean? Well, it means that interest rates, you should see interest rates rising, which is exactly what we are seeing now. So the question is, when will the stock market bottom and go up? Well, interest rates have to decline for several months for this bottom to take place. So let's see another example is okay, now the leading indicators like the stock market or the yield curve improves. When can we see commodities rise? Well, commodities will rise after we see the economy strengthening, and usually after a year and a half, you should see interest rates and inflation rising here. So when you see inflation rising, what does it mean? Well, it means that at some point you have to look for a peak in the stock market or in the yield curve. So as soon as the yield curve decline, what you say, like for instance, the yield curve is flattening. So what does it mean? Well, when you see the yield curve flattening, you know that you are headed for trouble. The economy is going to slow down. And when will the yield curve finally steepen and project a stronger economy? Well, only after interest rates and inflation and commodities start declining for at least a good year, So if now the stock market is this peak for 3-4 months, when we can expect the stock market to bottom? After several months. First of all, you have to have a an economic weakness, and then you'll have to see interest rates declining for a bit. Well, I hope you enjoy this information and this relationship. This work is a quick summary of a book that McGraw-Hill asked me commission that is been sold in the United States and above all in Asia, quite a bit extensively in Asia in several editions, which is called Profiting in Bull or Bear Market, How Business Cycles Impact the Financial Markets. And it's about also sectors and shows how the sectors are invested, perform during the business cycle. Of course, my research, my work is shown on www.peterdag.com every Sunday. Of course, there is a complimentary subscription if you would like to go there, and so you can check my work and all the articles and books I wrote. Thank you again for reviewing this video. I hope you find it useful and with information that you can apply. Again, I hope to see you really soon. So long.